Good morning and welcome to another edition of Rainy Days Podcast. This is our second episode in our first year of doing podcasts for Rainy. Rainy Days is designed to bring homeownership out there to people. Homeownership is more than just buying a house. It's about building a life, creating memories, navigating challenges, both big and small. Rainy Days is dedicated to helping you make the most of your home ownership experience with practical advice, emotional support, and a sense of community. It is my pleasure to have a fellow Rainy member on today, Kaye Kleinschmidt from Union Savings Bank, to be our guest today. Kaye has been a mortgage originator at Union Savings Bank. She's going to let us know for how many years. I know I've been on the Rainy board. Um, Probably for about 10 years. Kaye has been on as long as I have. And it's a pleasure having you on. And
Thank
you
you.
are a wealth of knowledge. And we would go ahead and introduce yourself, Kaye.
I certainly will. I'm Kate Kleinschmidt, and I work for Union Savings Bank as a mortgage loan originator. I started in the mortgage business in 1997. Some quick math tells me I'm closing in on year 29.
Mm,
So I've seen a few changes, as I'm sure you have too, JJ.
yes, ma'am. And how long have you been a Rainy member?
Boy, 10?
10. Yeah, that's what I say. When you think on it, I know I've been at the bank going on 5. I was at Housing Authority
Mhm.
for 5. That's why, my quick math says 10.
Yeah, I would say 10. I have my little rainy pin somewhere. I should have worn it today.
You're exactly right.
Yeah.
But no, it's a pleasure. And like I said, you always your go-to. You're active in Rainy in all our workshops and the things that we do. You're willing to step up. You lead committees. Where does your passion for home ownership come from, and the passion to give back and serve people? Where does that come from?
Those might be two separate directions or two separate passions. Home ownership, candidly, and I start with my first time home buyers by saying just this: home ownership isn't for everybody. If you don't want to fix the light bulb and don't want to figure out how to get a water heater installed and don't want to do things like that, or mow the yard, or do just maintenance things, homeownership may not be for you, because as any homeowner will tell you, it's an endless list of of what needs and what doesn't need. So, but helping people, yeah, I guess I would treat people the way I would want to be treated. I'm very lucky that I do know a little bit about mortgages and about home ownership, but I sure don't know much about other things. And I appreciate the assistance when I get it in areas of which I'm not sure.
Yeah, okay. And I can attest. I watch you work with people, and I'm big on telling folks anytime I present or anytime I've been on the podcast, it's about treating people with dignity and with respect. And you definitely, I watch, you interact with clients when they come in. That's exactly how you handle them.
Thank you.
Like you said, you're talking to them as people. You're talking to them from a position you want to help, and that's not always the case. So I always speak to that because that's something I don't want to, I take for granted, and I'm gonna call it for what it is. Um, your expertise is mortgages.
It is.
Yeah.
And before my expertise was mortgages, I worked for a fine jewelry company. So I still have a little bit of diamond expertise lingering around, but it's been replaced by almost 30 years now of mortgages. I got into the mortgage business absolutely by chance. I had the very good fortune of meeting Mr. Dave Ruoff, and he said, "I think you'd like this job." And I said, "Okay." The rest is history. I've been with Union Savings Bank for 12 years now, and this is my first job with a bank. I'd always worked for a mortgage broker before. There is a difference. The bank is the entity to whom you make your payments. A mortgage broker sells your loan. And that's fine. Neither is good or bad, and they both have selling points. But working for a bank is a little bit different because the people that own the bank that I work for are have let me do what I do, and let my heart grow even more for helping the entire community.
Okay, perfect, perfect. And again, so you're getting off into it. Our topic is ins and outs of mortgages. So, with that, talk to me about what is the process. Somebody walks in. I'm a first time home buyer. I want to buy a house. Walk me through that process.
Well, you're my favorite. I love my kids, and that's in quotes. I love my kids. Um, we don't know in this world what we don't know. And just because their buddy bought a house or somebody else they know bought a house doesn't mean their experience is going to be the same. So I start way back at the beginning and talk about, do you even want to do this? Why do you want to do this? Where do you see yourself in 5 years? Buying a house every year or so isn't probably for everybody. It's expensive and you don't let yourself live there long enough to build up any equity. So, are you going to be there for 5 years? Are you going to be there for 10 years? The first place that I start is with how much do you want your payment to be? And that number, 9 times out of 10, is more important than any number I calculate as far as ratios or guidelines or anything like that. If you tell me you can afford 1,500 and my numbers say you can afford 1,900, I'm not going to make you go to 1,900. I respect your life and what you do with your money, and everybody has different priorities. Maybe you do eat lobster every night. Maybe you have a different charitable giving schedule than others. Maybe you save a higher percentage than others. There's so many different options. So that 1,500 becomes my focus to help you get into the house that you wish. Now, the opposite of that is if you tell me 1,500 and my numbers come up with 1,200, then we've got to have a little bit different kind of a conversation.
Gotcha.
So,
So what about I tell you my number is 1,200,
mhm.
but the houses that I'm looking at houses that are $500,000. What do you tell? What are you gonna tell me?
I'm going to tell you that the mortgage amount that equals 1,200 a month is, we'll say, 200,000. And I didn't bring a calculator, so that's a wild guess, but for sake of example.
Correct.
So you're welcome to look at $500,000 houses, but know that you're going to have to put down $300,000 to make that ratio fit. Is that something you're comfortable with, sir?
Gotcha. Okay. And what you're speaking to, and I like getting acronyms out there is because people throw them around all the time. So to educate our audience, you're speaking to DTI. And what
Ex-
exactly is DTI?
Exactly right. Debt to income. We live and die by numbers on a piece of paper, by debt ratios, by percentages. And that's all well and good. But again, at this initial conversation, I'm going to be much more concerned with my buyer's comfort level. So debt to income ratio is figured two ways actually. The percentage of the house payment itself as compared to your gross income, that's your bottom number. Yeah, now I've got my number. Yeah, that's a bottom number. And then your top ratio is your total debt to income ratio. So that would include any payments coming with you to the new house. That would be your car payment. That would be student loan payments. That would be credit card payments. That would be personal loan payments. That would be child support payments. That would be any payment that's coming with you to the new house. That would not include your current rent because that will end once you buy your new house. And for right or for wrong, the industry doesn't make me account for your utilities. So, I don't know whether that's good or bad, but it's something that I always throw out. I'm only considering obligations that you're contractually liable to make. You have to make that car payment regardless of where you live. I guess you can choose to have electricity or not as you see fit, but
Well, I think that's how they come up with that number, that 42% to make up for the utilities that are out there. And it actually speaks to, you said something that's very key. If my numbers are saying, you can have $1,900 payment, but you're
yes.
saying only 1,200, we're gonna go with your comfortability, your level, your borrower, and that's perfect because again, when we talk to folks at our workshops and things, we always talk about being unique into our own household. And it's not about with the bank can't tell you what you can afford, your realtor can't tell you what you can afford.
Nope.
It's about your comfort level. And the other thing I'll speak to, the banks, we utilize gross. So when you want to do your formulas,
We do.
do utilize that net if you want a more accurate depiction. So that speaks to
Yeah.
everything that you talked about.
And again, for right or for wrong, that's the way the industry is
Yeah.
set up. And it hasn't changed in my tenure here. I don't, maybe it will in the future, but, and I start with that conversation as well. If you make $1,000 a week, you don't get to keep $1,000 a week, right? You lose some of that in taxes. So I'm going to use that $1,000 a week, but please know, that's not what you take home.
Exactly
And
right.
I've never had anybody argue with me on that point.
But yeah, and you definitely, again, and that's what I said. I appreciate the honesty, the understanding, of being upfront with people and having a realistic idea. Because yeah, if you're going off your net number and it's like, look, you can look somebody dead in the eye, look, this is what your net, this is what you bring home, this is your numbers, you're gonna be fine. And that's what people want to know.
Absolutely.
You got that room for error. If something's gonna come up, because something always is gonna come up. We know this, especially if you have kids.
Yeah.
But you want that cushion. So uh, now let's say somebody they're comfortable. You got their payment they want. You got the purchase price. What's next?
We're going to talk about your credit. And you have to, as a new home buyer, you have to truly bare your soul. And don't think I'm not going to find out, because I'm going to find out. It's going to show up on a title search. It's going to show up on a credit report. It's going to show up on a pay stub, a garnishee on a pay stub that you forgot to mention. It's going to show up. So you have to tell me every single thing in your life that you're making payments on. And we're going to take all of that into account. Yes, there are some exceptions. Maybe you only have a few car payments left. Um, then sometimes we have to count it, sometimes we don't. It depends on the loan. One thing that home buyers can be confused about are student loans. And they've confused everybody the last 5 or 6 years. On a student loan, if you're not making a payment right now, I'm going to go with the fact that eventually you will be making a payment. And I am going to count that payment against you. Maybe it's in forbearance right now. Maybe you're not paying on it right now, but chances are pretty good there will be a payment in the future.
Correct, and that's that 0.005, the half percent that we talk about. I
One
tell
half
people
of a
all the time
percent,
that 0.005.
which is down from 1%.
That's down from one
Yep.
percent, and whether it's forbearance, deferred, deferred. Explain to people all the time. Just means you still debt's still there. You still owe that money, and therefore lenders are going to take that into account. The other thing, you said you're not you making anything you're making a payment on is going to show up, and then you went to student loans. What about I got a car repoed 10 years ago. I'm not making any payments on that. I mean, is that going to pop up anywhere? How's
It
that?
sure could. I know one popular misconception is that things just disappear after 7 years. I've never seen that to be the case 100% of the time. Sure, I've had things not show up on people's credit reports. Um, that's the absolute exception to the rule.
Yeah.
So
And
if it's past due and if it's outstanding, chances are pretty good the underwriter, who is the ultimate judge and jury, is going to make that be accounted for.
yeah, no question. That's why I brought that up, because that a lot of stuff is shows up in derogatory. People aren't making payments. Oh, I forgot about that. Those people, they can't pick that car up. I said they can have it. Okay, you said they can have it. They picked it up, but it's still sitting there in your credit. You still owe them that money.
Exactly.
Credit card bills. I ran it up. Well, I canceled that credit card. That bill is still sitting out there.
Yeah.
You haven't made a payment, but it's popping up. Um, and there's a lot of special programs that are out there, and I know you guys have them as well, as our bank. But the one thing that even people that step outside and do stuff, get creative with credit, where we look at rental payment or rental histories and things of that
Sure.
nature. The one things that give pause and from lenders is if you have anything in judgment or if there's any collections out there, because lenders like being what they call first lien position, and if they're not the first in line to get their money back, somebody else is. That's the one thing you are
That's
going to
a
have to get
yeah,
cleaned
that's
up.
a hard stop.
That's
That's
a
a
hard
hard
stop.
stop. Um, Another obligation that people forget about is something that they've co-signed on for their
Yes.
friend, for their brother, for their son, for their daughter, whatever the situation is, because that other person is responsible and is making the payments, does not take you off the hook. If those payments don't get made, that lender's going to come looking for you. So that's a debt a lot of times that I have to count against you that
Correct.
maybe gets forgotten about.
There you go. Okay, my credit checks out. I'm 740. We got my purchase price established. What's next?
I would bless you and send you on your way to find a house, I think. Um, I would with a bunch of very serious warnings and rules and restrictions. First of all, do not change jobs. Do not change jobs. Do not quit your job. Do not think that that's a good idea, not during this process. Secondly, do not create any new debt. Oh, she's already run my credit. It's okay. No, no, no. And I jokingly tell people if you walk into a department store and they're offering free umbrellas to open a new charge account, you have to say no thank you and go back to your car and get wet because you just can't change what I now know to be true.
Got you. So explain to me. Okay, so at this point, am I? Is that what we call a pre-approval, or is that I can? I'm just ready to buy a house. What
Perfect.
is that? What is that? What are we in the pre-approval process? Where are we at in
I'm
this
going to
process?
start with the word pre qualify. They're used interchangeable. They might be interchangeable. I don't think they're interchangeable, but they might be. Pre-qualification is a conversation. It's something to what you and I are doing.
Yeah.
You're telling me what you make. You're telling me what your debt is. You're telling me how long you've been at your job. Pre-approval is me going that one step further and actually getting your documentation. Okay, he says he has $10,000 in the bank. Does he really? He says he has a 740 score. Does he really?
Mm-hmm.
He says he makes $1,000 a week. Does he really? After all that's been verified, we can move comfortably into a nice pre approval, which is not an approval and is still not a guarantee, but it is a step stronger than a pre qualification.
Gotcha. And it allows you to go look for the homes like you just
Exactly.
said.
Exactly.
Now, what about this scenario? I've got a friend who's selling a house, and we entered into a contract. For it, I didn't have a pre-approval because they were like, "Hey, if I'm good, I'm gonna give you. I got this contract. Can you still get that person financed?"
Probably. I mean, if they're financeable, you don't have to have a pre qualification letter or pre approval letter to go buy a house. Most realtors, I think, in 2025 are going to make sure that you have gotten your financing, or at least an idea of what you're talking about, before they show houses. But maybe not. I don't. Every realtor is different, of course. But yes, you can absolutely do that. You don't have to have a pre approval before you sign a contract for a house.
Okay, so really, it's just you got your contract, you coming in, you still got to get pre-approved, but now you just have that purchase contract, that purchase agreement, and just kind of expedites the process a little bit.
Exactly. I think what I would do is skip the pre approval phase and just go straight to the approval and go ahead and get those pay stubs, get those bank statements, get those W 2s, get those tax returns, get that court order of child support, get whatever documentation it is that we need
Okay.
and get it turned in and get that appraisal ordered and get you moving.
Okay. Now I'm out there now. What are rates and what are rates and what are some of the different mortgages that are out there?
Boy, I don't think we have long enough for that question, sir.
Yeah.
Um, when we get calls at the bank, hello, I'm just shopping. What is your rate today? There are so many answers to that. It might be 10 minutes before I even get around to quoting a number. Every program is different. Every credit score could result in a different rate. Um, If it's a purchase, it might be different than a refinance. If it's a cash out refinance, it might be different than a not cash out refinance. There's so many options. And I haven't even gone down the road of the different kinds of mortgages.
Correct.
There's a conventional mortgages, there's an FHA mortgage, there's a VA mortgage, there's a USDA mortgage. And then within conventional mortgage world, there's a couple different options there too that could affect the rate. So today, well, I can't quote today. Yesterday, when we closed business yesterday, my bank was at 6.125 on a 30-year fixed rate conventional mortgage purchase or no cash out refi,
Okay.
assuming that 740 credit score.
Okay. Perfect. Now, give me the cliff notes real quick. You name 4 different mortgages. Difference between what conventional, USDA, ever just cliff notes.
Sure. 2 major groups, conventional mortgages, government-backed mortgages. The difference is pretty easy. A conventional-backed mortgage is backed by private mortgage insurance, if needed, the dreaded PMI. That's offered by a separate insurance company, and that's not one size fits all. One person's PMI rate might be different than another person's PMI rate.
PMI, another acronym. Hit it.
Private mortgage insurance. Private mortgage insurance. If you're buying a house and you're not putting down 20%, you're going to have mortgage insurance some way, some shape, somehow. You might choose to pay it all up front at one time and not have it monthly. You might choose just to pay it as you go and just pay it as you need it with that monthly payment. That's the rate that you pay is influenced by your down payment, by your credit score, and by the credit worthiness that that private mortgage insurance company feels where you are on their chart. So there are a couple of different mortgage insurance companies, and their rates are very similar, but there can be a difference. So, as a loan officer, we kind of shop that around a little bit too for you.
Gotcha.
So that's the conventional side. Government side does also have mortgage insurance, but it's one number for every borrower. Doesn't matter how much you're putting down, the minimum 3.5% on an FHA, 10% on an FHA, there will be mortgage insurance involved. VA covers the mortgage insurance for their veterans. So there is no monthly mortgage insurance. And a USDA loan, again, a government-backed loan for specific geographic locations, is a very, very low PMI rate.
Okay. And the difference too, as you said, with that conventional, 20% is when that insurance comes into play. Those government backed, that insurance is a life of the loan. Yeah.
It can be. Another trick.
Okay.
FHA, if you're putting down less than 10%, you will have mortgage insurance, and they don't call theirs PMI, they call theirs MIP,
Yes.
just to make our lives more interesting. And that MIP stands for mortgage insurance premium, but it serves the same purpose. It guarantees that the lender will get paid if you do foreclose or default or such as that. FHA mortgage insurance will go away after 11 years if you're putting down substantially more than 3.5% than the minimum. But if you're putting down the minimum, then mortgage insurance stays for the life of the loan, period.
Gotcha. Okay. Got my house. We got our purchase contract. We got a conventional loan, 6.125. I'm moving to the closing table. Talk to me about closing costs, Rico. What exactly are closing costs and what goes into that?
Closing costs are as varied as the institutions that are available to get a loan from. Some lenders have a whole host of things that are important to them that they charge for. Underwriting review fees, document preparation fees. What are some of the rest of them called? I don't even...
I know, title work searches and...
Well, yeah, now that's a little bit different, but the lender itself can charge its own fees.
Correct.
Now,
appraisal fees.
Sure.
All that stuff.
Now, I've got a group of fees that we call pass-through fees. I have to have an appraisal on that house that you bought. I do demand to get title insurance, to get a title search, to make sure you're not bringing me any liens or judgments as you mentioned, that first lien holder position is important to a lender, and to assure you, my buyer, that the sellers aren't leaving you liens or judgments that are going to become your problem. So things like that have to be done. And where you see those charges on your settlement statement or on your closing disclosure are the actual charges from the actual provider, what the actual appraiser charged us. Lately, I've been seeing maybe 425, 450 for an appraisal.
Right.
So that's the number that you would see on your settlement statement. We don't mark that up. We don't get a cut of that. That goes to the appraiser. Another charge that you'd have would be for your credit report. I believe an individual report is in the $75 range. Flood determination fees, the closing fee from the title company, the recording fee from the county, all of those are what they are, what they are. There's no lender markup on any of those prices. In addition, some lenders do charge their own fees, though, and those are processing fees, document preparation fees, underwriting review fees, things like that are charged. Realtors charge fees to borrowers, and maybe that's a paperwork processing fee or a paperwork retention fee. All of those come into play too.
Okay. And what do you say? What's a ballpark of closing costs? Because then I don't think we touched on the prepaids, which would be your
Nope, that's a
homeowners
whole nother
insurance
zip.
and
That's a
taxes.
whole nother section.
But just a ballpark of what somebody would be looking at.
I can speak to Union Savings Bank
'Cause
since I've been there
and
for
that's why I
12
would say
years.
I
Yeah,
know you have a
I will
ballpark.
speak to Union Savings Bank. Our closing costs on a conventional purchase or conventional refinance are $500. That includes the appraisal, that includes the credit report, that includes the flood determination fee. My bank doesn't charge underwriting review fees, preparation fees, doc prep fees, paper retention fees. We don't charge any of that. My closing costs are $500. Other lenders are 2 and 3 and 4 and more times that. And again, that's fine. There's no right or wrong answer. Everything's a little bit different. That $500 that Union Savings charges does not include the title work, the title company's charges, does not include the recording fee, and does not include the prepaid expenses. If I can veer off a little bit, those prepaid expenses are establishing the escrow account for your taxes and your insurance, your first year's homeowner's insurance, and your interest that you're paying from the day you sign on that document until the first day of the next month. Those costs really don't vary lender to lender. The insurance that you've purchased through your insurance agent is whatever it is, whatever it is.
Right.
So it's not going to be different to pay me or to pay a different lender. So prepaid expenses really are pretty much the same wherever you go, for the
Gotcha.
most part. But actual closing costs from the lender, that's where you could see a pretty good $1,500 or more swing between lenders.
Correct. And you know what? And again, one of the things I love about Rainey is we have different banks and
Yeah.
lenders and people from all segments of home ownership. If you, whoever you go to, I mean, again, you compare numbers and you can literally go item by item and see, to your point,
Yeah.
where, they're charging me this, they're not charging me this. Each bank has special programs where they may, like you guys, your $500. I know we have a program where we waive lender's fee for home is in a certain area. Everybody has special programs. So it's all about, that relationship that we talk about establishing with somebody and, just comparing is there. And the beautiful thing about Rainey, as I tell people, you come in just like today, and I'm going to let you, when we finish up, you guys have a home ownership program. If you guys are offering something that we don't, or you got a better product that I think is going to fit somebody's need, we refer to one another.
And
And that's,
absolutely true, vice
yeah,
versa. We
yeah,
don't have every product. We aren't for everybody. When I'm fortunate enough that realtors, friends, previous customers, other people refer me as a mortgage loan officer, I tell my new buyers, I feel like I go on a whole bunch of blind dates and we'll be best friends for 45 days. and then you won't hear from me again for a while until there's something that, that I feel might be of interest to you. I'm not everybody's cup of tea, and you probably aren't either. I doubt
Right.
it, but you probably aren't either.
Listen to
So, I'm not going to fit everybody's personality, and that's fine. I want you to do what's best for you, my buyer.
Gotcha. Okay, before I wrap up, go ahead and talk to people about the home repair
Sure, I would
product
love
that you
to.
guys have, because I mean you got a couple slots left. I think it's a great
I
opportunity for
do.
people.
If you've got, will this show if I put it up?
Hold it up. She'll zoom in on it.
How about that? If you are already a homeowner and you are in a particular census tract, call me, first of all, and we'll figure out if you're in my census tract. Union Savings Bank right now has a very, very nice offer. It's $2,000 in home improvement money, interior or exterior, an improvement of your choice. I need you to be the homeowner. I need the home to be owner occupied. I need there to be income coming into the house. But remember, before we talked about ratios and qualifying and things, there's no minimum income. There's no maximum income. There's no minimum credit score. There's no maximum credit score. I need you to have income, and I need the home that you live in and the home that you own to be in a census tract that we're looking to serve. If this applies to you, and it's just a quick phone call to me, and I'll tell you, if it applies, I'll give you $2,000 to do whatever home improvement you want to do. Either I will repay you for a purchase that you're going to make, for maybe a new dishwasher, maybe a new refrigerator, maybe windows, maybe a new front door, maybe cutting a tree down, maybe maybe I don't, whatever you can think of. It cannot be a computer. It cannot be a television, because those would go with you if you moved, but it would have to be something for the house.
Okay.
Or if you don't want to buy it up front, you can get me a quote from a contractor, from the store that you're going to buy, on their letterhead, and we'll make the check payable to the homeowner and the contractor. And then you present that check to the contractor or to the store when the work is done to your satisfaction.
All right. Perfect. We appreciate you coming on today, Miss Kaye. Excuse me.
That's
Lord,
right.
look, I was going to call you Linda. I was going to give Linda Golden, our president, a shout out. We want to appreciate her. And as
I'm
Linda's
taller than Linda.
hey, there you go. But Linda is coming up and ending her term as president. We have a new president when we start in the new year. But this has been another edition of Rainy Day Podcast. I made it through without singing. For anybody that's out there, aspirations of becoming a homeowner, reach out to our website. R.A.N.I is out there. We're on all social media platforms. You can reach out, get connected with a lender. Reach out to one of us, personally, if you like. Like I say, J.J. Foster at Lake City Bank, Kaye Kleinschmidt at Union Savings Bank. Feel free to reach out for any realtors that are out there, or lenders, other banks that would like to join R.A.N.I, because again, excellent opportunity of coming together, bouncing ideas off, serving our community, which is the main point and focus of R.A.N.I. So with that said, happy holidays to everybody. We will see you after Christmas. See you next year. We'll be talking about home ownership and home insurance. So we'll have a guest again on from R.A.N.I talking about home owners insurance.
Thank you for having me.
All righty.